Imagine holding like a secret playbook to corporate tax efficiency, a guide that doesn't just lay out the rules, but really shows you how to strategically, minimize your tax burden and sidestep those really costly penalties. What if just a few key insights can mean the difference of hundreds of thousands, maybe even millions, for your business's bottom line? Today, we're taking a deep dive into the fascinating and I think often underestimated world of C corporation taxation. Our mission: to really distill the core computations, unlock the power of various tax credits — this is key for savings — and arm you with the knowledge to avoid significant penalty taxes. Think of this as maybe your shortcut to keeping more of what your business earns and putting it back into growth.
That's absolutely right. We'll explore not just the what, but crucially, the how and why behind these regulations. We want to connect the dots so you can understand not just the rules themselves, but their practical implications for your corporate strategy. Look, this isn't merely about compliance checks, ticking boxes. It's profoundly about optimization. It's about ensuring your business retains as much of its hard-earned capital as possible to reinvest and grow. Basically, turning tax strategy into a real competitive advantage.
Okay, great. Let's unpack this then. We should start with the absolute foundations of C corporation taxation, getting a handle on those core rules that every single business needs to navigate with precision. First up, filing requirements. Because let's face it, getting this wrong can set off a whole chain reaction of headaches and, frankly, unnecessary costs.
You've hit on the bedrock, absolutely. Every C corporation in the U.S., without exception, is mandated to file a U.S. corporation income tax return. That's Form 1120. Now, for the vast majority of corporations, especially those operating on a calendar year, so their tax year ends December 31st, this form is due by April 15th. That's the 15th day of the fourth month, right after the close of your tax year. So if your company, let's say Innovate Solutions, Inc., runs on a standard calendar year, April 15th is your big date.
Okay, April 15th. So if you're like our Innovate Solutions, a standard calendar year company, that date rings a familiar bell, much like for individual taxes. But I know there are some interesting nuances here, especially for companies maybe with different fiscal year ends, right? What
Yeah.
about them?
Absolutely. And the detail here, or rather the specific deadline, is crucial. For C corporations that operate on a fiscal year ending June 30th, the original due date has traditionally been a bit earlier. It's the 15th day of the third month after their year end. So for a June 30th year end, that would actually mean a September 15th deadline. However, and this is important for listeners to note, there's a change coming up. For tax years beginning after December 31st, 2025, even these June 30th fiscal year corporations will shift. They'll move to the 15th day of the fourth month, just like the calendar year, folks. So it's aligning everything, aiming to simplify things a bit down the road.
That's a subtle change, but yeah, significant. It really shows how tax laws are constantly, evolving, even in these seemingly minor ways. It just underscores how critical it is to know your specific tax year end. No assumptions.
Mm-hmm.
And what happens if that due date inconveniently lands on a weekend or maybe a public holiday?
Ugh. That's one of those sort of small practical wins for taxpayers. It can really take the pressure off. If the official due date falls on a legal holiday or a weekend, the deadline automatically shifts to the next business day. It's a practical benefit, means you're not scrambling on a Sunday or trying to file when everything's closed. We've all been there, right? Where the calendar just doesn't quite cooperate. This rule is a welcome bit of relief.
Yeah, that's a good practical detail. But let's be real for a second. Corporate tax returns, especially for growing companies like our Innovate Solutions, Inc., they can be incredibly complex. What if a company genuinely needs more time? Maybe to gather all its information, reconcile its books, or just navigate some complex transactions from the year. Are extensions easy to get?
Yes, they are. And they're incredibly common, actually. A 6-month extension is generally available pretty much automatically just by filing Form 7004. So if Innovate Solutions Inc.'s original deadline is April 15th, a timely filed extension pushes it out to October 15th. It's a straightforward process. It provides crucial breathing room for those complex tax situations, maybe gathering data from different departments or international operations, or simply managing workload during busy seasons. Honestly, it's often a sign of good planning, not necessarily last-minute panic.
And that June 30th fiscal year quirk we just talked about, does that apply to extensions too? Do they get a different extension period?
They do, yeah. It adds another layer of specificity, I suppose. C corporations with a June 30th year end receive a slightly longer 7-month extension. So their September 15th deadline can be pushed out all the way to April 15th of the following year. It's kind of an interesting asymmetry, gives them even more flexibility. But, and this is a really critical point, for all corporations getting an extension, while Form 7004 grants you more time to file your return. It absolutely does not extend the time to pay your taxes. Any estimated tax liability you owe, still due by the original deadline. Failing to pay on time can still trigger penalties, even with a valid filing extension in place. It's about getting the paperwork right, not delaying the payment itself.
Right. That's a crucial distinction. You get more time for the form, but not an interest-free loan from Uncle Sam. Speaking of payments, let's move into our next foundational topic. Estimated tax payments. This feels really central to proactive planning, avoiding those penalties, and it's a huge area for cash flow management too.
Precisely. I mean, the IRS, like any large organization, needs a steady stream of revenue throughout the year, not just one big lump sum at the end. So corporations are required to pay estimated taxes quarterly. These payments are due on the 15th day of the 4th, 6th, 9th, and 12th months of their tax year. For our Innovate Solutions, Inc., on its calendar year, that means April 15th, June 15th, September 15th, and then December 15th. And with each of these payments, typically 1/4 of your total estimated tax for the year is due.
Okay, so on the surface, it sounds pretty rigid, 4 equal payments. But I know there's some flexibility built in, especially for businesses with, say, really variable or seasonal income patterns. This is where strategic planning can really pay off, right?
Right. There is, definitely. And this is where some shrewd financial planning can make a massive difference for cash flow. Unequal quarterly payments are allowed if you use what's called the annualized income method. So imagine a business, maybe a company selling holiday decorations. They earn almost all their income in the last half of the year, right? Or think about a startup like Innovate Solutions. Maybe they have very little revenue early on, but they're expecting a huge surge later after a product launch. The annualized income method lets them base their estimated payments on their actual income as it's earned during the year. So they don't have to pay a full quarter's estimated tax when their revenue for that quarter was minimal or even zero. It really helps manage cash flow, prevents paying tax on income they haven't even seen yet.
That sounds like a really smart way to manage working capital, especially for businesses with those fluctuating revenues. Avoids pinching cash flow unnecessarily. But what happens if these payments aren't made on time? Or maybe the estimated amount turns out to be too low? What's the downside risk here?
Well, the downside is an underpayment penalty, and the threshold for this penalty is actually relatively low. It kicks in if the amount owed on the final return after all payments is $500 or more. So if your final tax bill when you file Form 1120 shows you still owe $500 or more, you could be looking at a penalty. That $500 threshold, it seems small, but it's important to remember, especially for small to mid-sized businesses. It often determines whether a penalty applies or not.
Okay, so $500, it's not just about paying something, but paying enough and on time. And I understand there's a pretty significant distinction here based on the size of the corporation, isn't there? Let's break that down. Maybe start with corporations other than the large ones?
Yes, this is a key differentiator, and it offers a kind of strategic advantage, a safe harbor, if you will. For corporations not classified as large, they have a bit more flexibility. They're required to pay the lesser of two amounts, either 100% of the tax shown on their current year's return or 100% of the tax shown on their preceding year's return. This lesser of rule is incredibly valuable. Let's say Innovate Solutions, Inc. had a really profitable year last year. If they expect a similar or maybe even slightly lower profit this year, they can base their estimated payments simply on last year's total tax liability. This gives them a predictable payment schedule and really reduces the risk of underpayment penalties, especially if this year's income is uncertain due to market shifts or, say, R&D cycles.
That sounds like a powerful tool for managing risk and just predicting cash flow. Having that reliable benchmark based on the prior year must be gold, especially when the current year's income might be volatile or hard to forecast. But are there any catches, any situations where you can't use that preceding year rule as your safe harbor?
There are a couple of important caveats, yes. You cannot use the preceding year's tax as your basis if the corporation owed no tax for the preceding year. Maybe they had a net operating loss, for instance. Or if the preceding tax year was less than 12 months long, which could happen in a company's very first year of operation, or if they changed their accounting period. These rules basically prevent companies from exploiting a zero tax year or a short tax period to completely avoid current year estimated payments, ensures the government still gets its ongoing revenue stream.
Okay, that makes sense. So that covers the other than large corporations. What about the large corporations? How are they defined, first off? And what's their rule? Is it, as I suspect, stricter?
Yes, significantly stricter. A large corporation is defined as one that had taxable income of $1 million dollars or more in any of its three preceding tax years. So once you cross that $1 million taxable income threshold, even if your income dips below it the next year or two, you might still be classified as large for estimated payment purposes for a while. It looks back 3 years. And for these large corporations, the rule is much less flexible. They must pay 100% of the tax as shown on their current year return, full stop. There is no lesser of option, no safe harbor based on the prior year's tax liability.
Wow. Okay, so that means a much higher risk for large corporations if their income fluctuates unexpectedly during the year.
Right.
They really need to nail their current year forecasting with pinpoint accuracy. It sounds like graduating from non-large to large corporation status requires a pretty significant shift in financial planning and forecasting discipline.
Absolutely. The implication is a much greater need for accurate, ideally real-time financial forecasting. Constant monitoring of profitability, sophisticated tax planning, maybe even involving specialized software or advisors. If a large corporation significantly underestimates its current year's income, it faces a much higher likelihood of substantial underpayment penalties precisely because they don't have that prior year safe harbor to fall back on. For a company like our Innovate Solutions Inc., as they grow and eventually, hopefully, cross that $1 million threshold, their quarterly tax planning strategy will need to become far more robust and dynamic, no question.
Right. So understanding which category your corporation falls into, large or not, is absolutely critical. It directly impacts how you manage cash flow and, maybe more importantly, how you avoid those pesky underpayment penalties. It's all about proactive financial health, staying ahead of the curve. Now, let's shift slightly and talk about the actual tax rate itself. I understand C Corp have a flat tax rate now, which is fundamentally different from how individuals are taxed, correct?
Yes, it's one of the defining features of C corporation taxation under the current law, Post Tax Cuts and Jobs Act. To arrive at taxable income, you start with your gross income, basically. All your revenue from sales, services, investments, pretty similar to how an individual calculates income. Then you deduct all your ordinary and necessary business expenses, wages, rent, utilities, R&D costs, depreciation, things like that. Once you have that final taxable income figure, it's subject to a single flat tax rate of 21%.
21%. Flat. That sounds, well, simple. It offers a degree of predictability, especially compared to the progressive tax brackets individuals face, where rates climb as income goes up. Does this flat rate apply universally within C Corp? Are there any exceptions, or is it 21% across the board?
It does apply across the board for C Corp. That 21% flat rate also applies to personal service corporations, or PSCs. These are corporations primarily engaged in providing professional services, think health, law, accounting, consulting, where substantially all the stock is owned by the employees actually providing those services. So a law firm structured as a C Corp, for instance, would also pay that flat 21%.
Mhm.
This flat rate definitely provides a high degree of predictability for corporations when they're planning their tax liabilities and modeling future finances. But while the rate is flat and simple, arriving at that taxable income figure, that can still involve a lot of complexity. Rules around what's deductible, depreciation schedules, inventory accounting methods, international tax issues. So the simplicity is really in the final rate calculation, not necessarily the whole journey to get to that taxable income number.
That makes perfect sense. It's a clear target, that 21%, once you've done all the intricate work of calculating your income correctly. And yeah, for many businesses, knowing that flat rate must really help with long-term financial modeling and investment decisions. Okay, now, moving beyond those foundational rules, let's dive into some truly strategic areas, tax credits. This is where companies can really unlock significant savings, optimize their tax position, and turn compliance into a potential competitive advantage. Let's start with what's known as the general business credit. Sounds broad.
It is broad, and intentionally so. The General Business Credit, or GBC, isn't just one single credit. Think of it more like a portfolio, or maybe a basket. It's a powerful combination of various individual credits that are all grouped together under this one umbrella, and it's specifically designed to incentivize particular activities that the government wants to encourage, things that often have broader economic or social benefits attached to them. This combined credit can be incredibly powerful for companies that qualify for one or ideally several of its components, because these credits allow you to directly reduce your tax liability dollar for dollar in many cases.
Okay, so it's like a toolkit, a basket full of valuable incentives. What kinds of activities or investments are typically encouraged through this general business credit basket? Can you give us some of the notable examples?
Exactly. A toolkit is a great way to think about it. Some of the most notable credits included in the GBC are things like the investment credit, which encourages capital expenditures on certain types of property. There's the Work Opportunity Tax Credit, or WOTC, which incentivizes hiring individuals from specific target groups, like veterans or the long-term unemployed. The Alternative Fuels Credit promotes cleaner energy use or production. But crucially, it also includes the Research and Development Tax Credit, the R&D credit, which is a major one, and we should definitely talk about that in more detail because its impact can be huge, especially for innovative companies. There's also the Low-Income Housing Credit, the Small Employer Pension Plan Startup Costs Credit for businesses setting up new retirement plans for their employees, and various other less frequent, more specialized credits. What's really fascinating is how these, seemingly disparate credits are all grouped together. It offers this powerful set of tools for companies engaged in specific activities the government deems beneficial. Businesses like our Innovate Solutions, Inc. should be diligently looking at their operations to identify which, if any, of these components they might qualify for. It's often hiding in plain sight.
Right. So it's about seeing if your existing business activities, or maybe planned activities, already align with these incentives. That seems like a really proactive way to find potentially significant savings. Is there a limit, though? How much of this general business credit can a company actually use in a given year? It sounds potentially very generous.
Yes, there is a limitation, and it can get a little bit complex in the calculation. The total GBC you can claim in a year generally may not exceed your net income tax, which is basically your regular tax liability minus certain other non-refundable credits. And then that amount is reduced further. It's reduced by 25% of your net regular tax liability that's above $25,000. Think of it maybe like a valuable coupon, but it has one of those minimum purchase required clauses, or rather, my maximum discount allowed. You can get significant savings, but you generally can't use the GBC to completely wipe out your entire tax bill down to zero. It ensures that businesses, regardless of credits, still contribute a certain baseline amount of tax. So while it's powerful, yes, there is a cap on how much of your overall tax liability can be offset by these combined credits in any single year.
Okay, that makes sense. A generous discount, but with a built-in floor, so to speak. Got it. And what if a company earns more credit than it can actually use in a given year because of that limitation? Does that excess credit just vanish? Is it lost forever?
Thankfully, no. That would be quite harsh. One of the really great benefits of the general business credit is its robust carryover provision. Generally speaking, unused GBC can be carried back 1 year, so you can potentially get a refund for taxes paid last year, and then even better, it can be carried forward for an impressive 20 years. Now, there might be some very specific limits that apply separately to individual credits within the basket, but that general rule 1 year back, 20 years forward, provides substantial flexibility for long-term tax planning. If Innovate Solutions, Inc. invests heavily in, say, qualifying R&D this year and generates a large credit but can't use it all due to the limitation, that credit isn't lost. They have a very long window, 2 decades, to utilize it against profits in future years. This is especially critical for industries like tech or biotech, where you might have large upfront investments that don't necessarily correlate with immediate profitability.
Wow, 20 years forward. That's a huge benefit for long-term strategic planning. It really allows companies to smooth things out, weather volatile income years, and still eventually get the benefit of those investments. Okay, now let's zoom in, as you suggested, on one of the most impactful components of the GBC, the Research and Development, or R&D, tax credit. This one sounds like it truly fuels innovation and offers some, maybe surprising benefits, particularly around savings.
It absolutely does. The R&D tax credit is specifically designed to stimulate research and development activity right here within U.S. companies by directly reducing their after-tax cost of that innovation. Its direct purpose is to make it more financially attractive for businesses to invest in developing new products, improving existing processes, or advancing underlying technologies. It's really a key policy lever for fostering economic growth and keeping the U.S. competitive globally.
How is that credit typically calculated? And maybe more importantly for listeners, what kinds of activities actually qualify? I think, like you hinted, many businesses might assume R&D is only for people in white lab coats working with test tubes.
That's such a common misconception, and honestly, it's probably why so many companies, especially smaller ones, miss out on this valuable credit. The most common method calculates the credit as generally 20% of the increase in your qualified research expenditures, or QREs, over a defined base amount. So it actively rewards growth in your R&D investment year over year. There's also an alternative calculation method called the Alternative Simplified Credit, or ASC, which, as the name suggests, can sometimes be easier for companies to calculate, especially if they don't have historical data for the base period. Regardless of which calculation method you use, the R&D credit is first computed separately on its own form, Form 6765. Then, because it's a component of the GBC, it gets rolled up and subjected to those overall limitations of the general business credit we just discussed. As for what qualifies, it's far broader than just lab coats and test tubes. For a software company like our Innovate Solutions Inc., QREs could include the wages of software engineers developing a new algorithm, improving an existing software platform, or even developing internal tools. For a manufacturer, it might be the costs of designing and testing a more efficient production line, developing new materials, or creating prototypes. Even think about, say, a craft brewery experimenting with new fermentation processes to create a unique beer profile, or a construction company developing a novel, more sustainable building technique. Those could potentially involve qualifying expenditures. The key concepts usually revolve around experimentation, discovery, eliminating uncertainty, and aiming for new or improved functionality, performance, reliability, or quality in a product or process.
Okay, so it's potentially much broader than people think. It rolled increases in spending, there are different ways to calculate it, and it rolls up into the GBC. But here's where I heard it gets really interesting, especially for small businesses. I recall something about a unique application of the R&D credit, specifically for them, something that goes beyond just reducing income tax. What's the potential game-changing benefit here for saving money?
This is truly a game changer, yes. And it's a benefit that, frankly, many eligible small businesses still seem to overlook, which is a shame because it's designed specifically for them. For what the IRS defines as qualified small businesses, this credit isn't just about reducing income tax liability down the road. It can provide an immediate cash flow benefit. A qualified small business for this purpose is defined generally as a business with less than $5 million in annual gross receipts. And this is key, having gross receipts for no more than 5 years. So think startups and early-stage companies. For these qualifying businesses, the R&D tax credit can be used to offset the employer portion of FICA payroll tax, that's the Social Security tax the company pays.
Wow. Hang on. Offset payroll taxes? Payroll taxes are a significant, often unavoidable cash expense for any business with employees. Being able to directly offset that expense with an R&D credit sounds like a massive boost to cash flow, especially for those early-stage companies, like Innovate Solutions in its first few years. They might not even be profitable enough yet to have a large income tax liability to offset. That sounds incredible.
It truly is. It's almost like a direct government subsidy or maybe a rebate for innovation happening at the startup level. Instead of waiting until you have a sizable income tax bill, maybe years down the line, to utilize the credit you earn today, you can elect to use it right now to reduce your quarterly payroll tax burden. This can have a profound, immediate impact on an early-stage company's cash flow. It frees up capital that can then be reinvested directly back into R&D or used to hire more researchers, accelerate product development, cover operational costs, or simply extend their runway during critical growth phases. Imagine Innovate Solutions, Inc. in years 2 or 3. This payroll offset could genuinely mean the difference between scaling up their development team as planned versus having to slow down due to cash constraints. Now, there is a cap. The amount of R&D credit that can be elected to offset payroll tax is capped at $250,000 per year for up to 5 years. But for many eligible small businesses, that's still a very substantial amount of immediate cash savings.
That is incredibly powerful. $250K a year against payroll taxes. So the takeaway here is huge. If your company is innovating, developing new products, improving processes, even if it doesn't look like a traditional lab environment, this R&D credit is absolutely something you need to be exploring, especially if you meet that qualified small business definition. It's a clear pathway to significant tax savings tied directly to your growth and innovation efforts. It really reframes the tax code from just a compliance burden to a strategic tool to actively fuel your business's innovation and expansion.
Indeed, it's a prime example of how understanding the nuances, the details within the tax code can directly translate into tangible financial benefits and ultimately give your business a competitive edge. Don't leave that money on the table.
Okay, fantastic insight on the R&D credit. Now let's shift gears to another strategic credit, one that's absolutely vital for any U.S. corporation operating on a global scale, the foreign tax credit. This is all about preventing that painful double taxation that can really erode the profits you earn internationally, correct? Making sure you're not taxed twice on the same income.
That's precisely right. The fundamental purpose, the whole reason the foreign tax credit, or FTC, exists, is to prevent a U.S. taxpayer's total worldwide effective tax rate from exceeding the U.S. statutory rate just because they earned income abroad. So, if a domestic corporation, let's imagine Innovate Solutions, Inc., successfully expands into Europe, pays or accrues qualified foreign income taxes to another country, say Germany or even a U.S. possession, they can generally choose to credit those taxes against their U.S. income tax liability that arises from their foreign source income. Without the FTC, you could absolutely face that double whammy: paying significant income tax in the foreign country where you earn the profit, and then paying U.S. income tax on that very same income when it's accounted for here. The FTC is designed to alleviate that.
So if Innovate Solutions is earning profits in Germany and they pay German corporate income tax on those profits, the foreign tax credit helps ensure they don't then pay the full 21% U.S. corporate tax on the same income again when they bring it home or account for it here. It avoids that double hit.
Precisely. It avoids that punitive double taxation, ensuring your global earnings aren't unduly penalized simply because they were earned overseas. It helps level the playing field. Now, a corporation actually has an important choice to make each year regarding foreign taxes. You can choose either to take a credit for those eligible foreign taxes paid or accrued, or you can choose to take a deduction for them instead. It's a critical decision because if you elect to take the credit, you cannot then deduct any portion of those foreign taxes in that year or any future tax year. You have to pick one path credit or deduction for those specific taxes, and that choice typically hinges, quite simply, on which option provides the greater tax benefit in that particular year.
And since a credit generally reduces your tax liability dollar for dollar, whereas a deduction only reduces your taxable income by your tax rate,
Yeah.
the credit is usually the much more beneficial option, isn't it?
Almost always, yes. A $1 credit saves you $1 in tax. A $1 deduction at a 21% rate only saves you 21 cents. So the credit is significantly more valuable in nearly all situations. Now let's walk through the calculation steps for the credit because it involves a crucial limitation that everyone operating globally needs to understand.
Okay, great. Lay out the steps for us and maybe help us understand the practical implications of each step as we go.
Okay, step 1. You need to determine your qualified foreign income taxes paid or accrued for the tax year. What makes a tax qualified? Well, the foreign levy must predominantly have the character of an income tax in the U.S. sense. This generally means it has to be a tax based on net income or profits, similar to our own income tax system. So things like foreign corporate income taxes, withholding taxes on dividends, interest, or royalties usually qualify. Something like a value-added tax, VAT, or a sales tax, however, would generally not qualify as an income tax for FTC purposes. Also, the tax must meet what's called the jurisdictional nexus or attribution requirement. Basically, it's generally allowed as a credit only if the income being taxed is properly attributable under U.S. tax principles to the foreign jurisdiction that imposed the tax. The foreign country needs to have had the right to tax that specific income.
Okay, so step 1 is identifying the right type of foreign tax paid on income that was properly sourced to that foreign country. Got it. What's step 2? You mentioned this is where the limitation comes in.
Right. Step 2 is where you compute the foreign tax credit limitation. This is a really critical step because its purpose is to prevent the foreign tax credit from offsetting U.S. tax on your domestic income. The U.S. only wants to give you credit against the U.S. tax that relates to your foreign earnings. The formula for this limitation is your total pre-credit U.S. tax liability for the year multiplied by a ratio. That ratio is your foreign source taxable income divided by your total worldwide taxable income. This ratio effectively determines the proportion of your U.S. tax liability that is attributable to your foreign operations. And furthermore, just to add a layer of complexity, U.S. tax law actually requires corporations to categorize their foreign income and the associated taxes into different baskets, for instance. There's a basket for passive income, like dividends and interest, another for general business income, maybe separate ones for foreign branch income or global intangible low-taxed income, GILTI. This is crucial because the FTC limitation we just discussed is actually calculated and applied separately to each basket. You can't necessarily use excess taxes from your passive income basket to offset U.S. tax on your active business income basket, for example. Okay. So that ratio calculation and then these separate income baskets, those are the key mechanisms. It ensures the credit only offsets the U.S. tax on the foreign income itself, not tax on income earned here in the U.S. And it also segments by the type of foreign income. That makes sense from a policy standpoint, preventing weird cross-crediting.
Exactly. It's a proportional limit designed to prevent foreign taxes from effectively subsidizing or reducing the U.S. tax owed on domestic profits. Then, step 3 is actually pretty straightforward. You determine the actual foreign tax credit amount you can claim for the year. It's simply the lesser of 1. The qualified foreign taxes you actually paid or accrued from step 1, OR2, the foreign tax credit limitation you calculated, in Step 2 applied on a basket-by-basket basis. This ensures you get the benefit of the taxes you paid, but only up to the amount of U.S. tax that was attributable to that foreign income. Okay, that framework makes sense. Identify the tax, calculate the limit, take the lesser. Let's run through a quick example to make this really concrete for everyone listening. Let's use a fictional company, Roco, a domestic corporation with some global operations.
Great idea. Examples always help. Okay, imagine Roco, a U.S. corporation, has $20 million of worldwide taxable income in a particular year. Of that $20 million, $5 million is properly sourced to its foreign operations. Let's say Roco paid $2.5 million in qualified foreign income taxes during that year, and we'll assume the U.S. corporate income tax rate is our flat 21%.
Okay, so following your steps. Step 1. Qualified foreign taxes paid by Roco is $2.5 million. Simple enough, that's just what they actually paid abroad.
Correct. Now for step 2, we calculate the foreign tax credit limitation. First, we need Roco's total U.S. tax liability before applying any credits. That's $20 million in worldwide taxable income multiplied by the 21% U.S. corporate tax rate, which equals $4.2 million. That's their tentative U.S. tax bill.
Okay, $4.2 million total U.S. tax before the FTC.
Then we calculate that crucial ratio. Foreign source taxable income divided by total worldwide taxable income. That's $5 million of foreign income divided by $20 million of worldwide income, which comes out to 0.25 or 25%. Finally, we apply that ratio to the total U.S. tax liability, $4.2 million multiplied by 25%. That gives us a foreign tax credit limitation of $1,050,000.
Right, so the U.S. tax that's considered attributable to their foreign source income is roughly $1.05 million based on that calculation. And then step 3 is where we figure out the actual credit Roco can take this year.
Yes. Now we compare the two key numbers. The qualified foreign taxes Roco actually paid, step 1, was $2.5 million. The foreign tax credit limitation we just calculated, step 2, was $1,050,000. The FTC allowed as the lesser of these two amounts, so Roco can take a foreign tax credit of $1,050,000 for the year. This directly reduces their $4.2 million U.S. tax liability down to $3,150,000.
Okay, so they get a significant credit, but it also means they actually paid more in foreign taxes, $2.05M, than they were allowed to credit against their U.S. tax, allowed by the 5M in this particular year. What happens to that difference, that excess $1.45 million in foreign taxes paid? Is that just lost money?
Excellent question. And thankfully, no, it's generally not lost. In this example, Roco has $1.45 million in excess unused foreign tax credits, $2.5 million paid minus the $1,050,000 they were able to utilize. These unused foreign tax credits aren't just gone. They can typically be carried back for 1 year, potentially generating a refund for the prior year, and then carried forward for up to 10 years. This carryover offers another valuable long-term planning tool, allowing companies like Roco or our expanding Innovate Solutions, Inc. to smooth out their global tax liabilities over time. It's especially useful if their foreign income levels, foreign tax rates, or U.S. tax liability fluctuates significantly from year to year.
So pulling it all together, what does this really mean for a global business? This credit is absolutely vital. It's complex, yes, with limitations and baskets and carryovers, but it's a powerful mechanism designed specifically to prevent that double taxation. It ensures your global earnings aren't unfairly taxed twice, just for crossing borders, which directly impacts your company's overall profitability and its competitive stance in the international market. You could argue that without something like the FTC, U.S. companies would be heavily discouraged from international trade and investment.
That's exactly the policy rationale. It's a sophisticated, albeit complex tool that aims to ensure the U.S. tax system doesn't unduly penalize companies for operating internationally. Instead, it tries to encourage global economic engagement and expansion by attempting to level the tax playing field between domestic and foreign earnings.
Okay, we've covered the core computations and some really powerful strategic credits, both absolutely fundamental for tax optimization and saving money. Now let's pivot to something equally important for safeguarding your corporate wealth and avoiding unnecessary and frankly painful costs. Steering clear of certain costly penalty taxes. We should probably start with the accumulated earnings tax, often called the AET. What's the story here?
Right, the accumulated earnings tax, or AET, it is precisely what you called it, a penalty tax. It's not part of the regular corporate income tax system. It's imposed on regular C corporations, not S corp, not partnerships whose accumulated earnings, meaning their retained earnings built up over time, exceed a certain threshold if those earnings are deemed to be improperly retained, meaning they're being held inside the corporation without a clear business need, potentially from from the IRS's perspective, to avoid distributing them as dividends to shareholders, especially shareholders who might be in high individual tax brackets. The core concern here is preventing the C corporation from being used as a sort of indefinite tax shelter for personal income.
Okay, so the key words there seem to be improperly retained. It's not just about accumulating earnings, which many businesses do, but accumulating them without a good business reason. What's the threshold for this tax? At what point does the IRS even start looking at whether the accumulation is potentially improper?
For most regular C corporations, there's a built-in safety net, a sort of minimum accumulation allowed without question. You're entitled to $250,000 of lifetime accumulated earnings before this tax can even potentially apply. This amount is often referred to as the accumulated earnings credit, or the minimum credit. It acknowledges that businesses need some level of retained earnings for basic operations. However, for personal service corporations, remember our examples like law firms, accounting firms set up as C Corp, that threshold is significantly lower. They only get $150,000 lifetime accumulated earnings credit. It's also worth noting who is exempt from this tax. It's generally not imposed on personal holding companies, which we'll discuss next. They have their own penalty tax, nor on tax-exempt organizations or passive foreign investment corporations, PFICs. They have other specific rules designed to address similar concerns about income accumulation.
And how is this tax actually assessed? Is it something a company calculates and pays on its own tax return, like the regular income tax? Or does the IRS have to initiate it?
This is a crucial distinction. The accumulated earnings tax is not self-assessed. You will not find a line item for AET on your regular Form 1120 corporate tax return. It is IRS assessed. This means it only ever comes into play as a result of an IRS audit of the corporation. During an audit, the IRS might conclude that the corporation paid insufficient dividends relative to the amount of earnings it accumulated, and critically, that these accumulations were beyond the reasonable needs of the business. If the IRS makes that determination and assesses the tax, it's a flat 20% additional tax imposed on those improperly accumulated earnings for the year under audit. So for a company like Innovate Solutions, Inc., if they start accumulating significant cash reserves year after year without a clear documented plan for using that cash, it could definitely raise a red flag during an audit and potentially trigger an AET assessment.
Wow, 20% additional tax. That's a significant hit, coming on top of the regular 21% corporate tax they already pay. So if the IRS comes knocking during an audit and raises this issue, how can a company defend itself? How can they avoid this tax? What's the primary defense? It sounds like it really comes down to proving the reasonableness of the accumulation.
It absolutely is about proving reasonableness, demonstrating intent, and most importantly, having the documentation to back it up. The primary defense, and the most effective one, is demonstrating that the accumulated earnings are being retained for the reasonable needs of the business. But this can't just be a vague assertion. It requires having a demonstrated specific, definite, and feasible plan for how those accumulated earnings will eventually be used. The IRS isn't looking for a general statement like, "We're saving for future growth" or "for a rainy day." They want to see concrete evidence. This means things like formal documentation in board meeting minutes, approving a specific factory expansion project, detailed capital expenditure budgets for purchasing new machinery, a multi-year R&D roadmap outlining future product development costs, or even a documented strategy for planned acquisitions, retiring significant debt, or funding substantially increased working capital needs required to support projected sales growth. Another specifically allowed reasonable need is accumulating funds to redeem corporate stock that's included in a deceased stockholder's gross estate, which helps provide liquidity for estate taxes. The key is turning saving money into strategic investment with proof. And interestingly, simply having widely held stock doesn't automatically exempt corporation from this tax, although it might make it harder for the IRS to argue the intent was purely shareholder tax avoidance.
Okay, so it's really not about punishing prudent saving for legitimate business purposes, but specifically preventing the corporation from becoming, as you said, a personal piggy bank just to avoid individual dividend taxes. And having that clear, well-documented business plan for the retained earnings is absolutely paramount. What if a company realizes, maybe during tax planning, that it might be vulnerable to this? Or maybe the IRS has already flagged them in an audit. Can they do anything after the fact to mitigate or eliminate the potential tax hit?
Yes, there are ways to reduce or even eliminate the tax, even after the close of the tax year in question, which provides a bit of a safety valve. Dividends paid within a certain period after the end of the tax year, generally by the due date of the tax return, including any extensions, can be treated as having been paid in the prior year for purposes of reducing or eliminating the accumulated earnings tax for that prior year. This allows companies to make what's sometimes called a purging distribution if they realize they might have an exposure. Also, hypothetical consent dividends can achieve the same result. This is where shareholders agree, formally, to treat certain amounts as if they were distributed as dividends for tax purposes, meaning they include it in their personal income, even if no actual cash changes hands. Both of these mechanisms really highlight the IRS's underlying objective here. It's less about penalizing the corporation itself and more about ensuring that the income eventually gets taxed at the shareholder level one way or another.
That raises an interesting point you touched on earlier. Why does the IRS actually care so much if a company saves its money? From a business perspective, strong cash reserves are often seen as a sign of financial health and security, right?
You're absolutely right, and for legitimate business reasons, the IRS generally doesn't care if a company saves. The AET is fundamentally an anti-avoidance measure. Imagine a high-income individual, maybe a founder, who owns a successful C corporation. If the corporation earns, say, $1 million in profit but doesn't distribute any of it as dividends, that $1 million stays within the corporation taxed at their relatively low flat rate of 21%. Now, if that same $1 million were distributed as a dividend to the high-income founder, it would be taxed again at their individual level. Qualified dividends are taxed at preferential rates, currently up to 20%, but you might also have the 3.8% net investment income tax on top of that, plus potentially state taxes. So the total tax hit could be significantly higher if distributed. The accumulated earnings tax is designed specifically to disincentivize using the corporation purely as a vehicle to indefinitely defer or avoid that higher level of shareholder taxation. It's about ensuring that capital isn't just parked inside the corporation forever solely to avoid individual taxes. It's the IRS looking for substance, a real business need for the funds, over the form of just letting cash pile up.
Fascinating. It really drills home the point that the IRS often looks beyond just the numbers on the return to the underlying business purpose and intent. Okay, now let's talk about another potential penalty tax, one that targets a slightly different kind of potential tax shelter. The personal holding company tax, or PHC tax. How does this one work?
Right, the personal holding company, or PHC, tax. This penalty is designed to prevent a very specific type of tax avoidance strategy. It primarily targets corporations that might be set up by high tax bracket individuals specifically to channel their passive investment income, think dividends, interest, certain rents and royalties, into a corporate structure. The motive they're trying to prevent is sheltering that passive income at the lower 21% corporate tax rate, instead of having it flow directly to the individuals where it would be taxed at their potentially much higher marginal income tax rates. It's basically trying to stop people from using a C corporation primarily as a personal investment portfolio wrapper just to get a lower tax rate on investment earnings.
Okay, so the focus here is clearly on passive investment income, and it targets companies that might look more like incorporated investment funds rather than active operating businesses. How does the IRS actually define a personal holding company? What are the specific tests they apply?
There's a pretty stringent two-part test, and a corporation has to meet both parts in a given year to be classified as a personal holding company for tax purposes. First, there's the ownership test. More than 50% of the value of the corporation's outstanding stock must be owned, either directly or indirectly, by 5 or fewer individuals at any time during the last half of the tax year. That indirectly part is really important and involves complex family and entity attribution rules. It means stock owned by your family members or by partnerships, estates, or trusts you're involved with can be attributed back to you. So this test looks for closely held corporations. Second, there's the income test. 60% or more of the corporation's adjusted ordinary gross income, AOGI, a specific technical term, must consist of certain types of passive income, known as personal holding company income.
Okay, closely held ownership is the first hurdle. What are those specific types of passive income that trigger this second test, the 60% income test?
The main categories of personal holding company income include net rent, but there's a significant caveat here. Rental income is generally not considered PHC income if it constitutes 50% or more of the corporation's AOGI. The idea being, if rent is your main business activity, you're likely not just a passive investment vehicle. Taxable interest income is included. Importantly, tax-exempt interest, like from municipal bonds, is generally excluded from this calculation. Royalties are generally included, but there are specific exclusions for things like mineral, oil, gas royalties, or copyright royalties if they meet certain active business criteria, as these are often considered active business income streams in those specific industries. And finally, dividends received from other corporations, particularly unrelated domestic corporations, are classic PHC income. So you could imagine a scenario maybe with our Innovate Solutions Inc. if the founders decided to funnel a large portion of their personal stock market investments into the corporate entity itself, and those investments started generating substantial dividend or interest income. They could inadvertently trigger the PHC tax if the company is also closely held, which it likely would be early on.
Okay, so if a corporation meets both tests, the concentrated ownership test, AND, the 60% passive income test, it's officially classified as a PHC, what's the damage? What's the additional tax assessed? Is it as hefty as the 20% for the AET?
It is indeed. Corporations that are deemed to be personal holding companies are hit with an additional tax of 20%. This 20% tax is levied on their undistributed personal holding company income for the year. It's a significant penalty, clearly designed to strongly incentivize the distribution of that passive income out to the shareholders. When calculating that undistributed PHC income subject to the tax, the corporation's regular taxable income is first adjusted. It's typically reduced by the federal income taxes paid for the year and by net long-term capital gains, net of the tax on those gains, before you then subtract any dividends paid deduction. This calculation aims to ensure the penalty applies specifically to the passive income that could have been distributed but wasn't.
So, similar to the accumulated earnings tax, it sounds like the key to avoiding this penalty is distribution. The IRS really wants that passive income out of the corporation and into the hands of the individual shareholders, where it will be subject to individual income tax rates.
Exactly. Distribution is the primary escape hatch. There is generally no PHC penalty tax imposed if the net income attributable to PHC activities is distributed to the shareholders. This can be done through actual cash dividends paid during the year or paid shortly after year-end, similar to the AET relief, or through those consent dividends we talked about earlier, where shareholders agree to be taxed as if they received a dividend even without cash. It's also really important to reiterate that corporations classified as personal holding companies are not subject to the accumulated earnings tax. The tax code prevents this kind of double penalty scenario for what are admittedly related anti-avoidance concerns. You get hit by one or the other, potentially, but not both on the same income.
That's a good point, preventing a double whammy. And how is this particular penalty tax assessed? Is it like the AET, where it's triggered only by an IRS audit, or is it different?
This is a key difference, and a really crucial one for compliance. Unlike the accumulated earnings tax, the personal holding company tax is self-assessed. This means if your corporation meets the two-part PHC definition for the year, you are legally required to calculate this 20% tax yourself and report it on your corporate tax return. You do this by filing a separate schedule, Schedule PH, Form 1120-PH, which must be attached to your main Form 1120. Failing to identify your PHC status and self-assess this tax if it's due would expose the corporation not only to the tax itself, but also to potential failure to pay penalties and accuracy-related penalties for substantial understatement of tax. The onus is squarely on the taxpayer here.
Wow, okay. So that really highlights the IRS's sophisticated multi-pronged approach to preventing different types of perceived tax avoidance using C corporations. For any corporation out there that has significant passive income streams and also has a concentrated ownership structure, 5 or fewer individuals owning more than half understanding these PHC rules is absolutely not optional. It's crucial planning to avoid a potentially hefty, self-assessed additional tax. So just to contrast them clearly, the PHC tax focuses on the type of income, passive, and the ownership structure, closely held, and it's self-assessed, whereas the AET is IRS assessed during an audit and focuses more broadly on the reasonableness of accumulating any type of earnings beyond business needs. These distinctions are critical for comprehensive tax planning because, as you said, if you don't even realize you meet the PHC definition, you could be in trouble without knowing it.
It truly emphasizes the importance of looking beyond just the basic income tax calculation and understanding the intent behind these more complex penalty provisions. They're not just arbitrary rules dropped from the sky. They are specifically designed to prevent certain forms of tax avoidance and ensure a degree of equity and integrity in the overall tax system. For businesses aiming to grow, manage their capital efficiently, and minimize surprises, staying proactively aware of these rules is absolutely paramount.
Absolutely. What we've really unpacked today demonstrates pretty clearly, I think, that C corporation taxation is far more than just filling out some forms correctly by the deadline. It's a complex but ultimately navigable landscape, and it's filled with both strategic opportunities, especially through credits, and critical pitfalls, those penalties that you need to avoid through careful proactive planning. From understanding your filing deadlines and managing estimated payments effectively, to strategically leveraging powerful tools like the R&D credit, especially that payroll offset, and the foreign tax credit for global operations. And then critically, steering clear of those potentially damaging accumulated earnings and personal holding company penalties. Every single one of these details really counts towards your company's bottom line and its ability to reinvest and grow. It really is about turning compliance into a potential competitive advantage, making sure every dollar earned contributes as much as possible to your future success.
And all of this really raises, I think, an important question for every business leader listening. In this world of ever-increasing tax complexity, both domestically and globally, how can your business ensure it's not just meeting the bare minimum for compliance, but is actually truly optimized? How can you be sure you're leveraging every single available tax advantage, every credit you're entitled to, and actively avoiding every potential penalty pitfall? How do you ensure every dollar earned contributes maximally to your growth rather than unnecessarily leaking out in taxes or penalties? The answer, I believe, lies in continuous learning, meticulous planning, staying informed about changes, and often not being afraid to seek expert guidance to help navigate these intricate rules effectively. It's really about actively building and maintaining your own secret playbook to achieve corporate tax efficiency.